Let's move forward to the multifamily housing market updates. Here is a chart from Yardi Matrix, and again, Yardi is a property management software that a lot of property management companies use, and so they gather data from all over the country and come up with this report. So as you see that from all asset classes and multifamily, meaning there could be different types, Class A, Class B, Class C type of multifamily properties, and if you just look at the rent growth, San Jose is actually close to 5% increase, and they're doing pretty well compared to Los Angeles, Inland Empire, San Francisco, Orange County, and Sacramento. So San Jose actually is doing better than the other major cities in California. And as for this one, we're looking at the year-over-year renewal rent growth. So after the tenant has lived there for a year, they're going to renew their rent. And as you see that Los Angeles, they actually have 8.9% of rent growth for renewal, and they're 44.6% of the monthly lease renewal rate. And the second place is San Jose, and I'm only looking at California cities, by the way, but obviously you can see that there are other cities as well. And then San Jose is at 8.8% and with 49.5% monthly lease renewal rate. And Orange County is at 7.9% rent growth and also a 61.2% renewal rate. And Sacramento is at 6.9% with 57% renewal rate, and San Francisco at 4.2% and 50.3% renewal rate. So I think this is a really good number. I noticed that I missed this one, Inland Empire, which is in Southern California. They are number one in our state, California. They're at 10.3% renewal rent growth, and they're at 54.5 renewal rate. So they are actually beating out all the other cities. Here is another report by PwC and also Urban Land Institute. It's from the report called Emerging Trends in Real Estate. And here is their investment prospect trends. Kind of want to see like which apartment as a type that is like the best investment prospect. So first one that they consider really good is moderate workforce type of apartments. I would say that that's more like Class B type of apartments, meaning that they're not as high end as Class A, but they're not as bad as Class C. You have some very solid workforce people that are living in those type of apartments. According to their report, they are the best prospect right now. And number two is single family rental. Single family rental is actually really doing really good right now. And it's a lot of our clients who own single family properties who want to rent it out, they pretty much don't really have any issues renting them out. And number three, we have senior housing and high income apartments. So senior housing, we have a generation of seniors that basically the demand has been really high, and it's an asset type that's been really popular for the past few years. And they're number three right now. Even though they're number three, they are still considered a good investment, and as well as high income apartments. And then number four is the lower income apartments. Lower income apartments, they did get hit pretty hard during COVID, and then it's been a long road. They're still recovering from that. Although they're number four, we are talking about they are still in between fair and good investment prospect. And number five, lastly, is the student housing. Student housing compared to the other asset type, they are not as good of an investment, but at least they are still above average. All right, so what are the recommendation? Buy, hold, or sell according to this report? According to this report, moderate income apartments, 52.7% would recommend to buy right now. Actually, they recommend the least is the student housing and also senior housing. And most of them, they're recommending that you should just hold. If you do have senior housing and student housing right now, you should just hold. But then it would also be a good time to consider selling these properties right now, the high income senior housing and student housing. They believe that it is better for you to just hold on to the lower income apartments and as well as the high income apartments and senior housing and student housing. As for the opinion of current apartment pricing, are they overpriced, fairly priced, and underpriced? Most people think that the senior housing, they are fairly priced, as well as student housing, they are fairly priced. And they believe that most of these high income and student housing, they are underpriced, while the moderate income apartment and also single family rental, they are overpriced. So this is I think it's just kind of nice to see on the chart to kind of compare. But because moderate income apartments, meaning class B apartment and single family, they're just such popular asset types. And that's why they tend to sell at a much better price as well. And then for National Multifamily Housing Council, they also came up with a report. And we have talked about this before. We all know that for a fact, this country, we just have this very low housing supply right now, but by how much? And we have heard many different numbers. For this report, it says the country needs to build 4.3 million more apartments by 2035. So we are 2023 right now. That means it's about in 13 years, we need to build 4.3 million more apartments. Now, 600,000 units are needed currently at a variety of price points. And of the remaining 3.7 million, more than 1.5 million new units are needed in Texas, Florida, and California alone. Just 1.5 million out of the 4.3 million units they're needed in Texas, Florida, and California. So it really shows that how much we, California, especially a big chunk of those, they belong to California and be really short on housing supply. And that is the biggest question is, how do we increase the housing supply? And I think this is something that's really important for policymakers to think about. I always say that policymakers, they need to have some business sense as well, to instead of just putting Band-Aid on a wound, they need to really dig deep and figure out how to fix this instead of just like slap on some kind of regulations to fix whatever they see in front of them for now. I'll share a little bit what happened in the city of San Jose. We have some really good news yesterday, but for now, let's look at the multifamily loan rate. And you see that multifamily loan rate, we have a little bit much bigger range on the interest rate. It goes from 4.95 to about, as high as 8.3% on the mortgage rate. And you see that the terms, they go from 5 to 25 years. So for multifamily loans, it's different from residential loans. A lot of times they amortize over 25 years, and sometimes you can amortize over 30 or 35 years. But then their fixed rate portion, it goes from, could be 1 year, 3 years, 5 years, 7 years. And typically we see that the most would be maybe like Freddie Mac loan at 10 years fixed rate, but after that will be floating. And so that's when people, multifamily owners, they need to refinance. So that is something that worth thinking about, because as I mentioned in the previous episodes before, as much as we see the residential market is doing pretty good, it's pretty healthy, but the multifamily market, that's where we see that because most of the loans, they have a short-term fixed rate. So for those people who have gotten their loan for 3.25% or 3.5%, and now if they need to refinance with high cap rate and also high interest rate, their monthly payment could double, or even they have to pay down the loan in order to qualify. So that can cause quite a bit of default that might happen soon. So this is a report I pulled from CoStar to look at East Bay multifamily market. If you look at the East Bay multifamily market, the vacancy rate, where currently we are at about 7.7% vacancy rate, they are expecting the vacancy rate to continue to go up. And also the annual rent growth actually is going to come down slightly for 1.2% to 1.5%. It's going to continue to go down until about 2024 4Q. That's when you start seeing the rent to start growing. And market sales price per unit is still ranging about $400,000 per unit, but it definitely, from this point on, it looks like they're predicting the market sales price is going to start to come down. And in terms of the sales volume, you see that the sales volume has shrunk quite a bit. So this is something that we should definitely, a lot of our multifamily investors who are interested in buying, they will realize that, gosh, I just don't really see a lot of inventory. And interestingly, despite our interest rates at over 6%, the cap rate is still lingering around 4%. And San Francisco, the vacancy rate is right around 7.4% right now for 2Q 2023. They're also expecting it to go up, continue to go up to about 8.5% to 2025. And then also the rent is going to continue to go down, especially after this quarter. And then the market sales price on average is about $660,000 per unit, and it's starting to come down to about $630,000 per unit. And the sales volume, same thing. Actually, the sales volume didn't shrink as much. It actually stays pretty relatively healthy right now. And the cap rate is at 6.5% cap rate. I know a lot of people ask me like, how is this possible? And this is one of the reasons why we have such a big gap between the seller's expectation and buyer's expectation. Buyers like thinking the mortgage rate is over 6% right now, 6.5% right now. How can we buy it at 3.5% cap? But then at the same time, the sellers are still expecting to sell at this price. So therefore, we still see a lot of buyers though have cash, and that's how they are able to manage to purchase these properties despite such a big gap between the mortgage rate and the cap rate. As for San Jose market, the vacancy rate, we are doing pretty well at 5.4% compared to East Bay and also San Francisco, and it's gonna top out at about 6.5%. And then the rent also gonna come down slightly, less than 1% for the next 2 quarters, but it's gonna continue to grow, although very little, but it's still, at least it's positive. And for the market sales price for the apartment units, it's going to linger around $600,000, and it's going to come down to about $566,000. And also the market cap rate is right around 3.5 to 3.7% market cap rate. And we see that the absorption unit would have come down quite a bit. If you look at Q4 2021, 8,715 units, came all the way down to 1,544 units. So as you see that there are definitely a gap between the buyers and the sellers expectation right now. And here's just a quick summary on Stockton, Modesto, and also Sacramento, where you see that market rent came down for Stockton, but Modesto actually have come up, and while the market rent for Sacramento has come down as well. And so these are the rent growth actually right now for Modesto is doing pretty well. And now for University of Denver and also Van Kuren Institute, they have these reports regarding the forecast on the apartment market for 2Q 2023. And we always want to look at cycles, right? Where should you invest and when you should invest? So by knowing and understanding where our market is, and by the way, I always say no matter what market you are, there's always a different cycle. So even though we can say like, today is a seller's market, but another city may not be a seller's market. So this is what we need to really look at, is that based on the city, where are we right now in that market? So you see the San Jose and San Francisco, we're kind of at the peak right now. We were in the expansion, but we're right around the peak. So it might start to come down like we had mentioned earlier on the charts. So this is something we also another reason why you see that a lot of apartment investors, they're just holding out, waiting right now for the market to start coming down before they invest in the apartment buildings, and especially in the Bay Area. And this is what I want to share with you guys earlier about the policy making. So yesterday, City of San Jose, they had their council meetings, and it has been a big debate regarding the COPA, Community Opportunity to Purchase Act. There are hundreds of people, and I think it went for about 5 hours meeting, and hundreds of people gave their feedback, their opinion, and of course, one group really against it and one group really wanting to vote for it. And then at the end, they did vote. Nine council members had voted against the COPA. And COPA, this is just in the simplest term, is that if a landlord needs to sell their property, if this passed, that means you have to sell it to the nonprofit first before you can put it on the open market, which is what San Francisco is doing right now. Santa Clara County Association of Realtors have been very vocal about this. You know, as we represent a lot of landlords, we do see that it could be a very unfair situation for these landlords. And honestly, most of the landlords, they are not greedy. They just want to have stable tenants. And so many of our clients actually friends with their tenants even. I don't feel like this COPA Act would actually help with affordable housing issues. At the end of the day, we need affordable housing for sure, but then by doing that, we have to have more housing by increasing the supply. And that's the question, is how do we increase supply? Will we be able to increase supply by implementing more fees on the developers or more red tapes? So that's a lot more to talk about, but I just kind of want to mention this with you all. Reminder with everybody, be sure to follow us on Facebook, Instagram, TikTok, and also LinkedIn. And of course, don't forget to subscribe on our YouTube channel. So I look forward to seeing you guys next month. Talk to you soon. Bye.